Big rate changes are coming May 1st. But hey, don't worry. John Walker here with Vision Mortgage Group, and I'm going to walk you through what those rate changes mean for you or your clients when it comes to purchasing a new home. During this conversation, if you have any questions, hit me up in an email or in the chat below the comments. That way I can answer those questions for you, because this could get complex, but I tried to make a 30,000 overview presentation here to give you an opportunity to understand what is really going to happen. So a few things that you're going to need to know and why you need to know these is what are loan level pricing adjustments, or LLPAs. We saw all over the news last week that if you had great credit and you put a lot of money down, you're going to get punished, whereas others that had lower credit and they're putting less down were not going to get punished. Who do they impact and when? What changes are coming? What solutions are available? Two programs that are rarely talked about but are very advantageous in this scenario, which is the Home Ready or Home Possible programs, some strategies, and then what we look at moving forward. So getting started, what are LLPAs? Well, they started back in April 2008, and what happened is as the market was changing back then, Freddie Mac and Fannie Mae realized that they were overexposed to risk because of all the crazy lending practices that were going on then. And instead of just making a clean across the board fee change, they started to do risk-based mortgage adjustments or assessments for folks that had more risk. They were charging a little bit more of a fee to help counterbalance or absorb that risk. In layman's terms, these were literally adjustments to the price of the loan. That this is an important aspect because loan prices are what determine a borrower's mortgage rate. So who do they impact and when? Well, LLPAs apply to only Freddie Mac and Fannie Mae loans only. So they do not apply to your FHA loans. They do not apply to your VA loans. They do not apply to your USDA loans. For clients, they often pay LLPAs in the form of higher mortgage rates, and low-level pricing adjustments vary by borrower based on the loan traits such as loan to value, credit score, occupancy type, number of units in the home, your debt to income level. There's so many things that go into play with this, but they do officially go into effect May 1st. And most lenders have already started to price that in for loans that are closing in May. So here's a graph over here, and this is something that sort of illustrates what these penalties could look like and how it's going to be impactful for you moving forward. So the effective penalty for having a credit score under 680 is now smaller than it was. Whereas if you were in the 620 to 640, it's actually gone up. So typically where we've all been trained and taught when purchasing and buying homes or even cars or whatever is the lower the credit score, the higher the interest rate's going to be. In this case, they're trying to shuffle that deck a little bit to balance that out, and they're using a word that I don't really like to use, but equality. And what we're trying to do is we're trying to help folks that, especially, your folks that are trying to get into homes, maybe they don't have quite the down payment, their credit score is a little lower. We're trying to balance that out with affordability is what they're really trying to do. I'm pretty apolitical on this. It's some people are going to say it's great, other people are going to say it's a travesty. But at the end of the day, my job here is just to provide good, sound advice and information so then you can make your best decision moving forward. So in this case, if we go to the next scenario, so in this example, if you had a 659 credit score, 659, you came in with 25% down on a $300,000 home. The old scenario was you were going to get punished, or you were going to pay 2.75%. So that would end up to be about $8,250. Where in the new system, it almost reduces it by half. So your new percentage per add-on to the normal rate would be 1.25%. And so you're looking at $4,500. So really the difference is about $3,700 in closing costs, which is pretty significant when we're talking about folks that are coming in with 5% and they've been saving all their pennies and dollars and trying to get into that home. Transversely, if you were a 740 credit score with 15% down on a $450,000 home, before you'd pay about a 0.25% or 25 basis points, which is $1,125. Really, it was just almost on par. Where now you're going to end up paying at that 15% mark, you're going to end up paying 1 full percentage point. So that's $4,500 of the loan amount. So your cost to purchase just increased by $3,375. So before, credit bands were very, very just simple. It was like about 740 to 800 and then 800 and above. Now they've established 2 separate credit bands inside that. So you have, your 700, 720, 740, but then you have 760 and 780. The other thing that they've established is that your debt to income, if it goes over 40%, there's a 0.5% LLPA attached to that. So if we have a lot of debt, and in some cases our debt to income could be at 40 up to 48%, you're looking in the example of $45,000 or $450,000 home, the example there, you're looking at over $2,250. This doesn't necessarily come out of your pocket up front, as some lenders can offer higher interest rates, but the costs are still there. So what that means is some lenders will provide like a 1/4 point higher interest rate, so then you're not paying that directly out of pocket. But this is where you really need to get with your lender and discuss these things with them, because this is going to impact your budget. And I would highly recommend that if your lender isn't talking to you about this, find a lender who will. Because again, our job as a lender is to make sure you have all the information you need to make your best decision. And really, that's what our job is here. And that's why I love working for Vision Mortgage. And I really embrace the mortgage coach philosophy, where I stand shoulder to shoulder with you, provide the information, and really help you move forward and realize your dream of homeownership. As we go forward, some of the programs that are not affected, which are pretty cool. So a Home Ready or Home Possible program. These are 2 great programs. So what they're saying is that if you come in with 3% down, you're a first-time home buyer, or you can be a repeat home buyer. You just haven't had owned a primary home within the last 3 years, and you're 80% of the median income average. If you're 80%, then what we can do is there's a special these 2 programs are special for this scenario, and they're dictated by which county that you're in. So there's an AMI lookup tool out there. You can Google it, or you can ask your lender, and they can let you know what your overall area and median income is. In this case, if you do qualify for one of these programs, all the LLPAs will be waived, so you ultimately get a less expensive interest rate, which is awesome. So keep that in mind. That's another little tool in the toolbox and strategy that we can use to move forward. How can you prepare realtors, how you can prepare your buyers, how you can prepare as you guys all enter into the spring market. There's a few things. Let's make sure that we improve our credit. We can communicate with our clients the impact their score can have on their interest rate as well as their closing costs. And remind them to work with a lender directly because they review credit and offer opportunities for improvement. So what's that mean to you? As a lender, I can see, when I look at your credit, I can see certain pathways that can help you with minimal effort in some cases, increase your credit score dramatically. That being said, we can also structure and look at how we're going to reduce your total closing costs. But it takes a certain level of mortgage coach to get this done and an advisor. And not every lender is the same. So again, I caution you, make sure you're working with someone that is willing to put forth the effort to go through these, because there's a lot of folks that are just, they're there to take an application and get you a loan, and they're not going to discuss all the nuances of this. One, refresh your seller's credit knowledge. So in this scenario, especially realtors and buyers, we need to make sure that we're looking at opportunities where, especially in this market currently, we can capture and use seller contributions for closing costs. These are very they're very program driven. So in a conventional setting like these loans that we're talking about, it's anywhere between 3 to 9% depending on the down payment that you're putting down. And so we should try our best to capitalize on these. One, to reduce your cash out of pocket, maybe reduce your income or your interest rate a little bit, but also when a seller starts to offer those contributions, we're seeing those houses move off the for sale side and move right into pending, because the buyers know that the seller is motivated at that point. And in some cases, based on some information I've gathered with some of the realtors that I work with, it reduces a lot of the negotiation time, because the seller's already been very upfront that they're going to offer X amount for closing costs. And lastly, is realtors, be a resource out there. Share what you've learned on social media. Use this education as a way to empower and re-engage your clients. Buyers, use this information to interview your lenders and your realtors. Make sure that they understand also these things, because again, you want the folks that are up to date with the market to best guide you in making your home purchase. And sadly, there's a lot of folks out there that just haven't taken the time to really study the market and invest the time to know everything or the nuances of how this market is shifting so dramatically on a daily basis. Hey, and lastly, folks, if you have any questions, here's my contact information. Please feel free to reach out. My phone number, my email address, it's all right here. So I look forward to working with you and really just helping you verify the information that you have. And our goal is to make sure that we always learn more. So if you have any more questions, just reach out to me. I look forward to it. Have a great day.